Welcome to the Deep Dive, your shortcut to being well-informed. Our mission today, we're unpacking a really foundational document of, let's call it, contrarian investing. The 1995 Shareholders Letter from Fairfax Financial Holdings Limited.
Right. This letter, it's more than just financials. It really marks the end of their first decade, 1985 to 95. And what jumps out is this blueprint for incredible index-crushing growth, while at the same time proudly rejecting almost every conventional corporate rule you can think of.
Yeah, we're diving into the philosophy of a company that, intentionally had no investor relations department, famously refused dividends, hated stock splits.
And celebrated low stock turnover.
Exactly. Celebrated that hardly anyone traded their shares. So our goal is to dissect how this, radical playbook actually delivered results. We're using their own words on the triumphs, the philosophy, and importantly, the real setbacks in that key year, 1995.
It really is the ultimate test of walking the talk, isn't it? Okay, let's start with the performance over that decade. When Fairfax started, they set this incredibly high bar, achieved a 20% average annual return on equity.
Okay, ROE, that's the key metric. Just quickly, for anyone maybe less familiar, ROE, return on equity, it basically measures how much profit a company makes for every dollar of shareholder equity. It's a crucial gauge of management efficiency.
Precisely. And the reality, over those 10 years, they hit 20.3%. So they just cleared the goal, as the letter sort of humbly notes.
Okay.
Now, put that in context. The main Canadian index, the TSE 300, it delivered only 7.5% ROE over the same period.
Wow.
Fairfax was delivering nearly triple the market average return to shareholders. That difference is just stunning.
The power of compounding at that rate is really something. We're talking about a scale transformation that honestly few companies ever achieve. Fairfax started out tiny, right? One small insurer, $17 million in premiums in '85. Fast forward 10 years, over $1 billion in revenue, $829 million just in premiums, 7 insurance companies, an investment counseling firm, a claims adjusting operation. It's a different world.
And look at the equity metrics.
Yeah.
In just 10 years, book value per share, that's like the company's net worth per share, it increased more than 25 times.
25 times.
The stock price followed right along, up 30 times. Investable assets, they just ballooned from $33 million to $1.7 billion.
Incredible.
They went from being this little micro-cap player to a major force in Canadian finance.
And their historical standing really confirms this wasn't just luck. Their 9-year average ROE, that 20.3%, ranked them 9th best among all TSE 300 companies.
9th best.
And their stock price growth, book value growth, 4th best for the same period. This wasn't just success, it was elite top-tier performance built on aggressive growth.
Right. But this brings us to the core, the how. How do you get that growth while rejecting all the standard market practices?
It comes down to their, let's call it, unconventional playbook.
Okay.
And it's designed exclusively, they say, to attract the long-term investor, i.e. investors who buy and hold our shares for the long term. Wait, so they're actively trying to discourage the average short-term trader? How does celebrating, the 8th lowest turnover on the entire index actually help me as a long-term shareholder? That seems counterintuitive.
Well, think about it. It creates a kind of strategic moat for management. If the turnover, how many shares trade hands each year, is only 20% of the public float.
Compared to the average of 60%.
Exactly. Compared to 60% for the TSE 300. It means your shareholder base is fundamentally stable. They're insulated from all that short-term noise, the quarterly pressure.
Okay.
They don't have to worry about, hedge funds flipping shares. They're accountable mostly to investors aligned with this decade-long philosophy.
Right. And this commitment to the long term, it really shows up everywhere. Let's tick through those famous anti-Wall Street policies. First, dividends. None.
That's right. 0 dividends. Their argument is, look, if we can reinvest earnings at 20% inside the company, paying out is just inefficient. They did, however, do a share buyback in '95. $6.9 million. Retired about 85,000 shares at $81. And they explicitly framed that as the most tax-effective way to return capital, called it equivalent to $1.77 per share dividend.
Interesting. So a substitute, but without the quarterly expectation.
Exactly. It avoids that expectation cycle dividends often create.
I have to stop you on this one, though. The stock split stance, it's probably the most quoted bit. They were firmly against them.
The cake analogy.
Yes. Arguing splits increase the number of slices that you take from a cake, but do not increase the size of the cake. I mean, that just perfectly captures the value investor mindset, doesn't it?
It really does.
A great anecdote to remember from this letter. The focus is only on increasing the long-term intrinsic value of the cake itself.
And that alignment between management and the long-term investor, it's solidified by ownership. This is what they call eating our own cooking.
Right.
Over 21% of all Fairfax shares, worth $189 million back then, were owned by directors, officers, employees. Their wealth is directly tied to the value they create.
And for any investor worried about, say, a sudden change in control, the CEO made this relationship totally ironclad. He controls all the multiple voting shares.
And explicitly states he won't sell, not even at 100% premium.
Wow.
Plus, he structured things so even his death wouldn't trigger a sudden sale. No short-term bonanza from a takeover. The philosophy is baked right into the corporate DNA.
Okay, let's shift gears slightly. The specific 1995 results, they just cleared that 20% target, right? 20.1% ROE.
Barely, yeah. But net income looked really strong, up 130% to $87.5 million, and the share price closed at $98, up 46% for the year. Pretty good year on the surface.
Okay, but here's where the numbers get a little tricky, maybe. The main driver for that huge jump in net earnings, it wasn't the insurance underwriting itself.
Right. It was realized gains, totaling $71.9 million, mostly stocks, $62 million, and about $10 million from bonds.
And what's fascinating, or maybe concerning, depending on your view, is the concentration there.
Absolutely. Those realized gains in 1995 alone, they represented a massive 87% of the total realized gains achieved over the entire preceding 9 years combined.
87% in 1 year.
Yeah. They basically needed this huge boost from, let's call it, good financial market timing in that 10th year just to meet their own long-term hurdle.
So the stock's up 46% to nearly $100 a share. Where does that leave the valuation? At $100, it was trading at roughly twice book value, price to book.
Which was near the top of its historical range at that point.
But compared to earnings?
A different story. Shares were trading around 10 times earnings, PE ratio of 10. Now, the significance here is the discount. The TSE 300 index was at 13.8 times earnings. The S&P 500 was pushing 17.8 times.
So even after that big run-up, the market still saw Fairfax as significantly cheaper based on current profits.
Exactly.
Which brings up that classic value investor's dilemma. Is the price getting ahead of the actual intrinsic value? The letter tackles this philosophically, right? Quoting Ben Graham.
Yeah, from The Intelligent Investor. Reminding investors, basically, that market quotes are just there for convenience, not instruction. Don't get too excited by rises or panicked by falls. Never buy or sell right after a big move.
Pure Graham. And that value focus dictated their investment strategy at the time. They noted finding good long-term value in the soaring U.S. market was tough.
Right. So instead, they kept finding opportunities quite abundantly, they said, in Canada, pointing out that the Canadian market had lagged the U.S. significantly over the previous decade.
Patience and contrarianism in action. Okay, let's pivot to the engine that actually produces the investment float, the insurance businesses. The key metric here is the combined ratio.
The combined ratio, or CR, simple but vital. It's your claims expenses plus operating expenses divided by the premiums you earned. If it's 100% or less, the insurance company is actually making money on underwriting before you even count investment income.
And Fairfax's target is 100% or less. But they admitted they only hit that target in 5 out of the 10 years, a .500 record, as they put it.
Yeah, not perfect on the underwriting front over the decade, but they definitely had some clear stars shining in 1995. Commonwealth Insurance, for instance. Superb year. 89.5% combined ratio.
Sub 100. Nice.
And consistent performance, too, which led to credit rating upgrades. S&P to A, D&P to A plus take. That's a big deal in insurance.
And Lombard. Sounds like it showed promise.
Huge promise. First full year normalized combined ratio was 103%. So close. But more importantly, the letter highlighted Lombard for revolutionizing the personal lines business. Said they had a productivity edge of up to 10 to 1 versus competitors.
10 to 1. Wow.
Yeah, positioning it, they felt, to break that 100% barrier in 1996. They were clearly focused on being the lowest cost operator.
Okay, but then the setbacks. And they were brutally honest about them, particularly Ranger Insurance. Called it a very poor year. The pre-indemnification combined ratio was unbelievable, was the word they used, 138.0%.
Well, 38, yeah. That's really bad in insurance. And the root cause, inadequate case reserving.
Which is the money set aside for future claims estimates.
Exactly. And for Fairfax, a company whose entire culture is supposedly built on conservative reserving, ensuring redundancies each year, admitting this failure,
right,
That's a huge moment of humility in a shareholder letter.
Absolutely.
It forced them to pump in an extra $14 million indemnification to stabilize Ranger and bring in new management, Pete Wallner, to basically shut down the bad lines of business and refocus purely on underwriting profit.
So the Ranger failure really proves that maintaining conservative reserves isn't easy. It's a constant battle, even for disciplined managers. It kind of reinforces why management is always preaching conservatism.
Definitely. And that conservatism extends to their, well, extreme risk management strategy, the nuclear bomb hedge, they called it.
Right.
They actually tested their regulatory capital against this hypothetical simultaneous market collapse.
Yeah.
50% drop in stocks, 30% in preferreds, 20% in bonds, all at once.
That is a dramatic stress test. And to protect against that kind of tail risk for one subsidiary, Lombard, they actually went out and bought insurance.
Pretty much. They paid $1 million for a 2-year put option on the TSE 300 index, designed specifically to hedge $70 million in Canadian stocks held by Lombard.
$1 million. That's real money.
It is. But think about the cost benefit. $1 million buys 2 years of protection against a potentially catastrophic loss on $70 million of equity. It's expensive insurance, you could say.
Mm-hmm.
But it ensures the financial strength of the underlying insurance operations stays solid, protecting that all-important float. It's the ultimate example of paying a premium just to sleep well at night.
Speaking of financial strength, let's look at the holding company's position overall. 1995 apparently ended the decade in the strongest financial position ever, largely due to a big debt financing, right? A U.S. $100 million debenture issue.
That's right. And this led to a key shift in how they reported debt. They moved from reporting gross debt to net debt.
Explain that.
Net debt is simply total debt minus cash. The reason for the switch. The holding company suddenly had about $70 million in cash sitting there after paying off some long-term bank debt.
So showing the net figure makes the balance sheet look stronger.
Well, they admitted it presents their position in a better light, but the change is conceptually sound. It highlights that their liabilities are significantly offset by very liquid, easily accessible cash.
Got it.
And this flexibility allowed the key net debt-to-equity ratio to drop quite a bit, from 56% down to 48%.
And finally, they built up a huge liquidity buffer, their little insurance, as they called it.
Yeah, they significantly increased their unused, unsecured, committed long-term bank lines, went from $105 million up to $215 million.
Wow.
And they pay $500,000, $540,000 annually just to have that facility ready. That small fee secures this huge instant liquidity valve ready for any crisis or maybe an opportunistic acquisition.
Okay, so let's try and tie this all together for you, the learner. Fairfax's success, looking back at that first decade ending in 95, it wasn't just about riding a bull market, was it? Although those realized gains were definitely needed to hit the 28.1% ROE that year.
Not just that, no. Their success was fundamentally about this radical, disciplined adherence to a long-term, value-driven philosophy, one that deliberately, actively rejected short-term shareholder expectations.
The focus seems unwavering. Increase the intrinsic value of the business, the cake through conservative underwriting, massive management alignment, contrarian investing,
Regardless of whether the market notices right away.
and that commitment to filtering out speculators, fostering a culture of humility, like admitting the Ranger failure publicly. That feels like the real lesson here. They succeeded by maintaining a focus that was measured in decades, not quarters.
And that leads us directly to our final provocative thought for you. The letter states quite clearly that their past record, that incredible 40% annual compound growth in the stock price over the prior period,
Yeah.
not repeatable in the future, they said. Given this strict focus on intrinsic value over market price, how should a long-term investor, someone dedicated to this value philosophy, how do you decide when a company, based on book value and conservative principles, has simply gotten too expensive?
Right. When is the price just too high to justify holding? Even for the long term, when is the right time to sell?
Something to chew on until our next deep dive.